Hi everybody, this is Rich with another episode of OWA Live. It's good to have you back here with us again. All the talk right now is going on in the markets around how do you respond to a bear market? How do you invest? How do you navigate through difficult investment times? I wanted to talk about 3 do's and 3 don'ts of things to be aware of as you invest and as you look forward. One of the things that happened last week, the markets were brutal. As you know, the S&P was down significantly and actually entered into bear market territory. That means that the markets, that particular market or that particular indice is down 20%. The NASDAQ's been there for a while because it's primarily made up of tech stocks. So what are the things that you need to make sure that you do when you invest in either the S&P or in the NASDAQ? Well, the things that I would suggest that you look at, number 1 is you need to make sure that you have a strategy. Believe it or not, a strategy should apply just as well in a growth market as well as in a declining market. So you should know what the range is on how much you can gain and how much you can lose at any given time. It should be no surprise. If you are panicking today, it may be because you need to build a strategy, a more concrete strategy, with your advisor that can help you figure out how to navigate your investments. So number 1, you need a very strong strategy on both the upside and a strategy on the downside. The second thing I'd recommend is look at the types of companies you're investing in. Quality stocks or quality investments. It could be investment grade bonds. It could be anything like TIPS, I-bonds, dividend paying stocks. Whatever you're in, make sure that you revisit that list of investments and you know exactly how they've performed in the past, although we know that the future is certainly not correlated with the past and is always that big disclaimer you always see from your financial advisor. But the reality is that historic performance is an indication of what you should expect. So look at your investments, make sure that they are quality, make sure that they are rock solid, and you can predict accurately how they're going to perform in an up and a down market. The last thing I wanted to mention to you is make sure that you stay the course. Stocks are what we call on sale. So what you need to consider is, if it was a good investment 6 months ago, it should be a good investment today. Stay the course. If you're putting 15%, 10%, 5% of your income and investing for the future, if you were doing that a year ago while growth was occurring in the market, now is an even better time to invest. So stay the course, keep planning for your future. Now let me give you 2 or 3 things to consider of things that you should not do. Number 1, don't panic. Know that if you've got a good strategy, there's no need to become emotional or become anxiety ridden about where your assets are invested. If you have that strategy, there's no need to panic. You are locked and loaded. You know exactly the range of performance that you should expect, and should not be an emotional decision. It should be a logical decision. The second one I wanted to mention is related to trying to time the market. Statistics show so many people try to get in at the right time. The reality is that many try to time the market, but they can't do it. And so most financial articles, if you talk about trying to figure out when to get in and when to get out, we get it wrong, or we're not able to consistently predict. So let me suggest that you implement a tool known as dollar cost averaging. That means you invest either when the markets are going up on regular periodic investment amounts, or if the market is going down, you do the exact same thing. You invest while the market is going down. Every 2 weeks or every paycheck, you're investing that money into the markets, and that is known as dollar cost averaging. The last one is that if you are an investor that sold property, you're sitting on what was called PPP money or government money, and you're sitting on a lot of cash, let's get that cash invested. There are, as I mentioned, I-bonds, government-issued TIPS, or other kinds of investments. You're going to lose 10% on your money this year if you don't. All you're trying to do is not keep up with 10%. You're just trying to put a dent in that inflation number that we keep hearing about. So those are the 3 do's and the 3 don'ts. just do what you can. If you have questions, give us a call. Call your financial advisor. Let's see if we can help you with those do's and don'ts with the markets. Okay, everybody, until next time, have a great day.